Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, January 21st, and the market mood today is, I would like safety, but make it liquid.
I felt that. My group chat is basically people stress-refreshing gold charts and asking if a savings account can be a personality trait.
Today we've got four tight stories. Gold hitting record territory near $4,800. Berkshire possibly cleaning up its Kraft Heinz stake, Davos-level anxiety about government debt after Japan bond volatility, and a defense IPO setup with KNDS picking banks.
That's a fun lineup. It's like shiny rock, ketchup, bond panic, and tanks. The most confusing grocery list ever.
Story 1. Gold futures are at fresh all-time highs, with reports noting international prices breaching the $4,800 per ounce mark. The driver is classic risk-off demand. Trade war tension and geopolitical uncertainty pushing people toward perceived safety.
So gold is doing that thing where it climbs like it's late to the airport. Is this the world is ending gold, or my portfolio needs a seatbelt gold?
Think of gold like a financial fire extinguisher. You don't buy it because you love fires, you buy it because you hate being helpless when smoke shows up. But if you buy after the kitchen is already fully on fire, you're paying peak extinguisher prices.
Okay, but normal people hear record high and think I missed it, which is also how I feel about real estate, retirement, and sometimes brunch reservations.
Actionable take. If you want gold exposure, treat it as a position-size decision, not a headline decision. For many diversified portfolios, a small allocation is the point, something like a single-digit %, rebalanced on a schedule, not chased on a spike.
So set it and forget it, not sell my couch and buy coins. Got it. Also, can we say out loud that gold doesn't pay rent and doesn't send dividends?
Exactly. Gold is about protection and optionality, not income. If you're worried about near-term bills, the first safe haven is still cash flow, emergency fund, manageable debt, and not being forced to sell investments on a bad week.
Speaking of not being forced to sell, story 2 is Berkshire and Kraft Heinz, right? The news is basically Buffett's empire might be breaking up with ketchup.
Yes, the item says Berkshire is preparing to exit its roughly 28% stake in Kraft Heinz, with the angle that it's a rare blemish and reflects a willingness, especially under Greg Abel, to move on from a past deal.
I love when even the most patient investors are like, actually, this is not a vibe. It's comforting, like seeing a Michelin chef admit they burned toast.
The finance lesson is sunk cost. Imagine you bought a gym membership in January, and by June, you're only using it to charge your phone in the lobby. Keeping it because you already paid is not a strategy. Reevaluating based on future value is.
My portfolio has a few phone-charging gym memberships. So what's the practical move? Sell anything that's embarrassing?
Not automatically. Practical move, do a quarterly keep, cut, or cap review. Keep if the thesis still holds. Cut if the thesis is broken. Cap if it might work but you don't want it to dominate your future. That's how you avoid nostalgia investing.
Okay, story 3. Davos people are stressed about debt again. I saw the phrase bond vigilantes, which sounds like Batman but with spreadsheets.
The news item frames it like this. After Japan's bond market chaos, Davos attendees are asking when investors might target the mountain of U.S. debt. In plain English, it's the risk that buyers demand higher yields to hold government bonds, raising borrowing costs across the economy.
Translate that to normal life. Are we talking mortgage rates, car loans, credit cards, like my entire adult existence?
Yes, bonds are the economy's price tag for money. If government yields jump, it's like the base price of borrowing rises, and lenders reprice everything above it. Even if you never buy a bond, bonds buy you, through your loan rates and what stocks are worth when discount rates change.
So the bond market is basically the thermostat. When it breaks, everyone's sweating, and the landlord is like, have you tried paying more?
Exactly. Actionable take, if you're carrying variable rate debt, this is your reminder to reduce sensitivity. Refinance when possible, Prioritize high-interest balances and keep your emergency fund more liquid so you're not forced into expensive credit.
Last story, KNDS, the Franco-German tank maker, picking banks for an IPO. Defense stocks are having a moment, and I'm trying not to be the person who discovers a theme after it's already on its third victory lap.
The report says KNDS selected banks for a listing, aiming to tap huge investor demand for defense stocks. The finance behind it, IPOs often show up when there's strong appetite and attractive valuations. Companies sell shares when the market is willing to pay up.
So IPO timing is like posting a selfie when your skin is clear and the lighting is perfect. You're not doing it during flu season.
That analogy is painfully accurate. For everyday investors, the move is not chase the IPO, it's define the exposure. If you believe defense spending is structurally higher, you can express that through diversified funds, position limits, and a time horizon that survives headlines.
And maybe read the prospectus instead of just vibing with a ticker symbol that sounds like a Wi-Fi password.
Quick recap. Gold near $4,800 is risk-off behavior. Size it, not chase it. Berkshire potentially exiting Kraft Heinz is a masterclass in ignoring sunk costs. Debt jitters matter because yields set the borrowing baseline. And the KNDS IPO story is your reminder that hot themes attract listings, so manage exposure, not excitement.
And if your plan today is panic, then refresh, please upgrade to plan, then rebalance. Refreshing is not cardio, and it's not a strategy.
If this helped, subscribe, leave a rating, and share it with a friend who texts you, "Should I buy gold?" every time the news gets spicy. We'll be back with the next briefing.
Also, comment what you're watching this week. Gold, yields, or earnings. I'm watching my budget like it's a prestige drama.